Welcome, everyone, to the mid-year update with IntentGen Financial Partners. My name is Jacob Schatz. I'm a partner at the firm, and I'm excited to have you joining us as we look at markets overall, look at some themes, and look at the economic backdrop. I'm also joined by two other counterparts on the team. One is Pat Morris, our in-house CFA and investment manager, and then new to our panel, excited to have him here today. He's been doing a lot of work behind the scenes, both on the planning and the investment side, is Andrew Abel. So he'll be sharing couple of updates too, and excited again to have them. As you've joined in these in the past, and some of you are new to these, since we're mid-year, typically what we'll do is we'll look back at high-level themes, we'll update those, and then we'll drive into some of the tactical things within portfolios. We won't look at every single asset class, but we will look at high level, a couple on the fixed income side and a few on the equity, and then also real assets and private markets. So let's take a look back to January, and we have three high-level themes: fragility, durability, and age of alpha. That really helped shift the allocations coming into the year as we were concerned over full valuations, concentration on the U.S. side, and the risk of reigniting inflation. And reality struck then. We had executive orders, Liberation Day, sweeping legislation, really was trying to reshape the economic order, which created a period of change. And volatility spiked in April as we were all digesting the policies. But thankfully, cooler heads at that time prevailed both in Washington and in the markets, and volatility subsided and markets rebounded. But for now, we're feeling that investors have appeared to have grown comfortable with being uncomfortable. But still, we do really remain in the early stages of potential significant and lasting shifts in the economic policy. So in times like these, we really rely on some of our principles. So we've got four of them, but one is diversify with intent, not by default. So diversification isn't about owning a little of everything. It's about aligning your views on opportunity and risk with humility, as we know the future is really unknowable at this point. So be selective, be thoughtful, and above all, be humble in times of change. Number two is time is your ally. You've heard this before, right? So it's not about timing the market, it's time in the market. So compounding, we joke, is the eighth wonder of the world, but only if you give it time. A long-term lens is going to be really helpful in portfolio resiliency. And three, price matters. So even the best businesses can be a poor investment if you overpay. Valuation, we should use it as a guardrail, and it may not just reveal opportunity, but keep you out of trouble. And four, compensated for calm. In times of uncertainty, markets test temperament. We see that even more than intelligence at times. So when fear grips others, your discipline becomes your advantage. So as I mentioned, we're going to look ahead to the second year. We'll look at our high-level long-term capital market assumptions have remained steady. We're going to look through a couple of the key developments and dive into our three themes on the next page. So those three themes, again, were fragility, durability, and age of alpha. So fragility, we saw high valuations and concentrated equity indexes and the risk of reigniting inflation. April was a stark reminder. The severity of the market's reaction, despite the extreme but not yet implemented tariffs at the time, really underscored investor sentiment. How had that become? So in healthier conditions, markets typically weather a lot of those shocks with more resilience, but we do believe that fragility really remains a key element to success in 2025. Durability, so intentionality is key, and durability is available at modest cost. We had portfolio positioning through fixed income, which we were, potential rate volatility was driven by inflation. We also saw staying consistent by having global diversification. So on the global equity side, that put greater emphasis on opportunities outside the U.S. And then real assets, as we continue to have that as a component, that's helping mitigate some of the volatility on a wide range of inflationary risk, both economic, geopolitical. But throughout the year, these allocations have really demonstrated to be as relevant today as they were at the start of the year. And then lastly, age of alpha. So no single market environment reliably tips the scales for or against active managers, but we are going to find times where active managers are going to lag. They're also going to face headwinds, but when they excel, we see that performance outperform against other asset classes. So we think it's prudent to have even more hands on the wheel in active management and continue to find opportunities through active allocations that are going to exploit those opportunities in certain asset classes. I'm going to turn it over to Andrew. So one of the things that we just hit on was fixed income, which again, has always been a dedicated piece in your portfolios, and we've seen that performance. So he's going to highlight some of the various classes within fixed income and then the corresponding returns and some of the yields that we're seeing.
Thanks, Jacob. Appreciate it. There's a lot of info on this screen here, so I'm going to dig into just a few of a couple key points and highlights. So that top table there, we're looking at trailing returns, year-to-date numbers specifically. We can see that the U.S. aggregate bonds have yielded roughly 4%. A couple of the others here, corporate high yield has performed well year-to-date at 4.6, roughly 10% over the past year. And lastly, the other one we want to look at is U.S. Treasury tips, or in other words, inflation-protected bonds, which have also yielded in line just under 5%. Moving on to that table at the bottom of the slide, we're seeing yields staying static right now. Not a lot of changes as it relates to yield and duration, but we may see some movement as interest rates change over time here. Saying that, there is also some volatility within the fixed income space due to concerns about inflation, a growing deficit, and uncertainty around monetary policy. But overall, we're seeing fixed income rates around 4% or so, which is pretty strong considering the circumstances. So moving on to domestic equities here. Again, there's quite a few tables, so I'll dig into a few of them for you. That table on the top left of the slide here shows the month-to-date and year-to-date performance on large, mid, and small caps. A couple key points. We've seen steady returns around 6% throughout the large cap space. So value, blend, and growth. We've seen a bit more differentiation amongst the mid caps, with mid cap growth stocks outperforming value and blend. We've seen a little bit of underperformance on the small caps month to date. Actually, year to date, month to date, they've been doing pretty well and keeping up with large and mid caps. So that graph on the bottom here. The S&P, as I said earlier, it's roughly up 6% year to date. The breadth of the returns this year are great. A lot of talk over the past couple of years has been around the S&P 500's concentration risk in the Magnificent Seven, but we're seeing returns coming from sectors outside of tech, with industrials and communications leading the pack here. One thing we do want to take into consideration is that the S&P is not an equal weighted index. So just under 50% of the S&P is composed of tech and financial companies, while roughly 18.5% of the S&P is composed of communication services and industrials. So again, just something we want to consider here when we look at returns. I do also want to say the standout so far this year has been international markets, which Pat will dig into a little bit later here in the presentation. So last thing I want to cover here, this table here, this is what's called the Economic Balance Sheet Diffusion Index, which I know it looks a little bit confusing, so I'll kind of dig into what this means. When we think of the assets and liabilities that pertain to the status of the overall economy, there are some signals that are supportive of the economy, such as the labor market and employment, which can be seen under the assets section. There's also some liabilities or unsupportive signals toward the overall economy, and as listed, housing, consumer confidence, government deficit, and trade deficit. And we're kind of near that neutral, messy middle, is what we call it, which you can see on that graph there. We're a little bit under zero right now, but there's a lot of factors that could go toward that asset side or the liability side, which can be seen on that neutral column. And all of these things, they're creating somewhat of an uncertain picture toward the overall economy currently. So that's where we're standing at the moment. I'm going to pass it on to Pat here now, and he'll dig into some other things here further.
Yeah, thanks, Andrew. And uncertainty is basically the topic of these next two slides. So the one on the left is more of what we call like soft data. It's a lot of consumer confidence and surveys and stuff like that. A lot of it is kind of forward leaning or looking. And that, as you can see, it was higher at the beginning of the year. It has kind of come down because of the uncertainty surrounding the tariffs and the possibly higher interest or lower interest rates or higher interest rates on the long end. And so, it's made businesses and households more cautious. Now, compare that to what's on the right side, and that's the hard data. So you're looking at the unemployment rate, real GDP. I will preface this by saying that number there that you see in gold, 1.6. That was an estimate. Since this chart has been made, we've actually got the numbers back, and GDP grew at a 3% rate for the second quarter. So, still some good data on the hard side, not so good data on the soft side, and a lot of it is creating this, uncertainty. And then this is an interesting start. So, go back 90 days, as Jacob was talking about, and we were at Liberation Day, and it was crazy days for that first part of April, and we came out with all these tariffs and or what we were going to do with tariffs, and since then we have gotten some negotiated, some that have been pushed out. It was pushed 90 days and it was pushed to August 1st. Recently, we saw some go into effect. Some have been pushed even further. But we're getting to get some clarity on this, right? So one of the things that we're getting to see is we struck a deal with the UK, and that was at a 10% tariff rate. And they're one of the few partners that we have, a positive trade surplus or balance with. And so that, if you think of that, you think of that as the floor. That's probably not going to go any tariffs below 10%. On the other side, there is Vietnam, which we negotiated a 20% tariff, and then 40% on some trans shipping goods. So say blended rate around 30%. So that you can almost think of as a ceiling. So not that we're going to say everything is going to be smashed between 10 and 30%, but we're getting clarity on how far along they are going. Now, this is a really interesting chart in that, 90 days was kind of a pipe dream or a Pollyanna type scenario, because if you look on average, it takes somewhere between usually 4 months and 30 months to get a trade deal or to get tariffs negotiated. And then, from launch date to implementation is even longer. But as investors, we don't really need to know about implementation. We just kind of need to know more certainty. So, and I think you see that in the market, right? When this past August 1st, we were thinking, oh boy, are we going to go back to Liberation Day? Are we going to see more volatility? And, we saw it go down one day, but then it's kind of come back up. Not to say there isn't volatility in the market, but, thankful for all of us, it's not as volatile as it was back in April. And outside of this, though, the one thing is China. So China is really anywhere, they're on their own. They're not in between the 10 or 30%. That will obviously be the biggest trade deal that gets negotiated. And that's not just Trump 2.0, that was Trump 1.0. This was something that started back in his first presidency or his first term. So for the year, kind of what our allocation shifts were at the beginning of the year, and then what's happened and what we'll think about going forward. So U.S. bonds we decreased. Now, we didn't decrease the asset allocation to bonds, but to core bonds, we lightened up on core bonds, and we increased on TIPS and dynamic bonds. As Andrew explained earlier, TIPS is the Treasury inflation protected security. So those both worked out well. I mean, on the level, dynamic bonds outperformed the core bonds, so did TIPS. So that part I thought went very well. On the global side, we trimmed back slightly on international and emerging markets, but we still hold in most portfolios between 25 and 30% of your equity is in foreign securities. So that has helped the portfolios. We increased our allocation to U.S. mid and small cap. This was done because we thought the new presidency or the new administration would be helpful for small and mid cap stocks. We still believe so. And the whole tariff thing kind of took off the first half of the year, but the signing of the one big beautiful bill, if I can, I have 3 B's in there, has, we've seen mid and small cap stocks do perform slightly better over the last couple of months. And so I think once we start focusing on tariffs are behind us and we start focusing on domestic policy more, that these policies or these stocks should see an improvement. So let's dive into the global asset classes. And, as Andrew pointed out earlier, fixed income. It's done well, and it looks relatively healthy. One of the healthier things is that, it's, and if you look at this chart, it's how this is compared over the last 20 years, where where the bonds rank now. And for most of them, it's in the upper, at least the upper half, or the upper quartile, or even at the least upper half. So you're seeing good yields, right around 4.5%. So that's a good, even if the market goes sideways, you're getting a good yield. On the far right, you see that the two things that are kind of concerning a little bit are the investment grade spreads and the high yield spreads. Not that they're just at historically low levels. And some of that is just, I think the confidence people have in the corporate market. We haven't seen a lot of bankruptcies and stuff like that. So, and the high yield spreads, while still overall the spread is 7%, the all-in yield is 7%. That represents the amount over the risk-free rate is at a pretty low compared to historical terms. So, when we talk about rates and how rates are going to change, there's two levers that we have, right? Fiscal policy and monetary policy. And how this is judged, or how it's done. If you look at fiscal policy now with the passing of the bill, they have their foot on the gas. All the tax changes that were going to go in, or all the tax changes that would have expired, continued on. You saw, a lot of other parts of the bill for, first year depreciation, stuff that is very, economic growth friendly, that is going to build the economy. Now, it could, increase the deficit, but, as far as pushing forward, that's what the fiscal policy is. And meanwhile, you have the monetary policy who's got their foot on the brake. There's a lot of economic uncertainty. While the labor market looks fine, I mean, there's no need for them, they think, to cut rates, at the last meeting anyways, when the employment numbers look very, very good. But there's economic uncertainty. So you kind of get this contradiction. And, which leads to something that we wanted to talk about, the independence of the Fed. Here you see the 12 members of the Fed. And just so everybody knows, Jerome Powell is the leader and he's chairman of the federal committee. But it's not an autocracy. He doesn't decide for himself if we're going to raise rates. And he's the face man, but it's a 12-person panel. And 7 people need to agree to either cut interest rates or raise interest rates. Now, some people are hawkish, some people are dovish, but the makeup is 7 are appointed by the president, and then 5 are Fed chairmen from the local, or from the banks, the regional banks. So right now, the Chicago gentleman is on it. Is Boston? They'll roll off in a year, and then they'll be replaced by somebody else. So the Fed will always be, it's not like a Congress where you can kind of put a bunch of your own people in and get it, kind of push things through. Imperfect as it is independent. So focusing back on bonds, or on fixed income. So as you all know, fixed income, when interest rates rise, bond prices fall. And so if you look at the US 30-year Treasury, this chart here, the light green is kind of the current yield. So if you look at the 30-year Treasury, the yield is about 4.8%, which is a healthy yield. And then the blue number is what would happen if interest rates rose 100%. And the light blue is if they fell 100%. So as you can see, if they fell, it would be a very nice payday, but there's also a lot of risk with that. And the 30-year is not really controlled by the Fed. The Fed controls those short end. The long end is definitely kind of market driven. It could be, so you can see a shifting of the, we were in an inverted yield curve. You could start seeing a more sharper upward trending yield curve. So, we think the sweet spot is right where we're at right now is the Bloomberg US aggregate. So it's probably the duration is somewhere between 5 and 10 years. As you can see there, it has a nice asymmetric, as they all do, but this one's kind of a asymmetric return. Whereas if interest rates fell, you would see some nice price improvement. And if interest rates rose, you wouldn't see it eat into the yield that much. Currently a yield, a 4.5 yield. So what does this mean? Well, if bonds went sideways and, you kind of didn't change, the interest rates didn't change that much, you'd still be making 5.5%, probably a little bit more, because, right now the bonds that were bought in most of these portfolios were at a discount. So you're going to see some general price improvement. And we've seen that this year. As Andrew pointed out earlier, bonds are up 4%, tips are up even more than that. And, high yield was up even more. So the flip side, while we're going to talk about that, we're also going to talk about U.S. equities and full valuations. Now, if those of you who have saw these before, we went over this multiple times, and the full valuation. So basically, what this chart is going to show is on the top, or on the x-axis, you're going to have earnings per share, and that's the amount of earnings that each company generates, and then divided by the number of shares they have outstanding. And then the y-axis, or on the left there, is the forward PE. So that's the multiple that investors are willing to pay for each earnings per share. And so when times are good and people think things are rosy and the growth outlook is exceptional, people are willing to pay more or higher valuations, right? So in this chart, if you look where the current meets the current, and it's at 0, which makes sense. So right now, if you have our current earnings at the current 22% or 22 times earnings, we would basically be flat. If you look one square over where it says 6%, that's basically the consensus right now, is that earnings will grow 6% for the rest of the year. And so if you said, hey, I'm going to keep or if the market believes to keep the multiple at that current 22%, or 22 times, 22 times, that the market should grow, or the S&P 500 should grow at 6%. Now, if they grow at the average that they've grown over the last 10 years, which is 8.5%, you'd be looking at about a 9% growth, right? But, on the flip side, if the earnings stayed the same, and, people in the uncertainty decided, well, I'm not so certain on what the future is going to be, and we went back to the 10-year average of the multiple, you could be looking at a 10% downside. Now, does that mean you should go out and sell all your equities and buy bonds? No, by no means. Well, but we're just pointing out here, you see a lot of red on this compared to green. And that's just something that we kind of constantly look at. Now, look, this chart is probably changed it's definitely changed over the last couple of years, but I'm sure 2 years ago, this looked somewhat similar, right? We've been worried about valuations, but we continue to kind of focus on this. And basically, one of the reasons why we're focusing on it is that, we do a 10-year, along with our research partner Fiducian, we do a 10-year capital markets assumption. And, over 10 years, we believe that equities will outperform bonds, and they should. Like, you shouldn't be taking extra risk if it wasn't needed. But the amount that it's going to outperform is fallen to about 1%, which is, not historical lows, but it's lower than its running average. So that is something that we continuously look at. Every month we get the new numbers. We always look at what we think, or what the numbers tell us we should do in terms of, the allocation difference between bonds and fixed income. Now, a lot of this is already in the numbers. So if somebody was on autopilot and just kind of let it drift, your 60-40 portfolio, which you might have been happy with, might now be 70-30, or, and that should be maybe a time to pull it back. But this is something we'll continue to look at. The earnings for the quarter, while it says 5.8, the earnings so far have been pretty strong. The number of companies reporting positive earnings are good. And so right now, there's less volatility due to, the policy or the tariff changes. So but we continue to monitor the situation. And one of the things that also was the first quarter, as Andrew talked about, and he said I was going to dive into later, is that the amount of the performance of foreign and emerging markets over the first half of the year. The developed markets was up almost 20% versus 6% for the S&P 500. And, a lot of that was for the dollar weakening. So a weaker dollar, obviously the currency translation helps out those foreign companies, but that wasn't the picture. That wasn't the entire picture, right? So if you look at the bottom, the US was 6.1%. If you look at the EFA and the emerging markets, they were 8% and 11%. All in, foreign companies did well, regardless of the dollar. The dollar tailwind definitely helped them. And why was this? Well, because, better policies in China, a more defense spending, and a better monetary policy in Europe. So you're seeing that. And then the valuations. Foreign stocks have a less valuation than the US stocks. Now, this leads to a question that, it's come up, same thing when we talk about people having questions about the Fed. Other people say, what about the US dollar and its reserve status? So reserve status means the US dollar is pretty much what everything gets traded in. When people buy oil, they buy oil in dollars. If you look, you see foreign exchange transactions, 88% of them are dollars. And even though the dollar is down 11% for the first half of the year, as you can see, that yellow line, it's above its long-term average. And if you look, these things seem to happen in groups, right? So the 2 or 3 year period, the dollar is falling, and then a 2 or 3 year period, the dollar is rising. It doesn't kind of go flicker back and forth. It seems to be like a longer term phenomenon when it happens. With that, I'm going to turn it back over to Jacob, and he's going to give you a brief synopsis of the One Big Beautiful Bill.
Yeah, thank you, Pat, and thank you, Andrew, as well. That's a lot of data and information to go through, and really helpful updates. I think, as you can see, a general theme is still the fragility and durability, and a lot of uncertainty with economic conditions going forward. And what we are seeing as an investment committee right now is an in-depth review on valuations. And right now, as of today, we don't need to make any changes, but valuations are certainly on our radar as we look at portfolio positioning. And I think it's a great time as an individual client to review your accounts. And what we'll likely see is some individual repositioning, whereas perhaps, as Pat said, your portfolio has gotten a little bit more equity oriented than what you're comfortable with. So maybe we need to pull that back. Maybe it's opposite direction, where you're feeling like you can take on more risk. And specifically looking at some of your individual winners. So we have clients that have to take distributions. We have clients that gift. And so this may be a good time to say, okay, we've got a specific security has really recovered well from April. Let's go ahead and either take profits on that or gift it, redistribute and use it potentially. And then also teeing up this fall is, as Pat alluded to, is our One Big Beautiful Bill. So nearly 900 pages. I think, as it says, the Treasury and the IRS are still digesting it with guidance. And we are too, because anytime we see tax law changes, especially going back to 2017, when the first Tax Cut Jobs Act came out, there's opportunity. There are planning opportunities pre and post implementation of the bill. So we are seeing adjustments on the standard deduction, AMT relief, estate gift tax changes. There's some deductions for seniors age 65 and older. There's also auto deduction interest is now deductible, but that's not necessarily an incentive to go buy a new car, right? we don't do it just for that taxes, but there's things to be aware of that. At one point you weren't able to deduct, now you can. There's also phase outs in order for you to receive some of these relief, but a lot of stuff to digest. And we plan on holding a webinar specifically on this as it relates to planning opportunities that we are seeing. Some other highlights that you can see: campaign-driven tax relief, estate tax changes expanded, full expense and interest deductions for corporations, targeted spending cuts. The debt ceiling was increased. So really on balance, we're seeing a dose of fiscal stimulus that's going to likely support some near-term equity sentiment while reinforcing pro-growth. But at the same time, it also still worsens already elevated deficits with spending levels, which are typically only seen during periods like recessions. We just see some renewed volatility as it relates to this announcement. Bond saw that, but I would just say again, we are going to be digesting it, getting more information out on you. It's 900 pages can be condensed into one slide, and we'll have a separate discussion on that. But again, I thank you so much for your trust and confidence in our firm. We have the pleasure and honor of serving each of you, and look forward to continuing to work with you on your investments and your planning. And thank you again for joining us. We hope you found it beneficial and look forward to speaking with you soon.